Okay, hi there and welcome to a growth and development profile video. We're going to spend a few minutes looking at the West African country of Senegal, a country which enjoys a favourable geographic location. It's got a major seaport and it's got easy access to European Union and North American markets. Fascinating country, well worth looking at from a growth and development perspective for your exams. One of the reasons I've chosen it is because Senegal is in the top 5 fastest growing countries on the African continent, according to the latest forecasts from the International Monetary Fund. It's worth reminding that sustaining something like 7% growth per year, as Ethiopia, Rwanda, Ivory Coast and perhaps Senegal are doing, that can lead to the size of a country's GDP doubling every 10 years. So definitely worth a look at Senegal. This is a really interesting chart. The leading players of Senegal at the 2018 FIFA World Cup by market value 2 years ago. Now, can you think why this might be relevant to the Senegalese growth and development narrative? We'll come back to that in a second. So let's take a look at some of the familiar HDI development indicators. Always worth knowing some of these for the countries of your choice. GNI per capita for Senegal is below $4,000 PPP. Their HDI ranking is 166. And indeed, their ranking on HDI is 12 places lower than their ranking for GNI per capita. So, why is that happening? Why is Senegal not yet converting growth of GNI per capita into better relative development positions? Notice at the bottom of the table there, the heavy dependence on remittances and overseas aid as a share of GDP, and also a very low labour market participation rate. Less than half of the population of working age are active in the formal labour market. One of the reasons I've chosen Senegal is because it's another good example of a country where remittance flows have increased substantially in recent times. Indeed, in 2018, that figure climbed above $2 billion for the first time. And this takes us back to our list of top Senegalese soccer players. Remittance inflows to Senegal on a percentage basis rising, climbing, as you can see, significantly now, well above 8, perhaps 10% of GDP per year. In 2018, remittances to sub-Saharan Africa were estimated at just below $50 billion. Now, Nigeria accounted for nearly half of that, Ghana 4 billion, Kenya maybe 3 billion. Senegal is the 4th biggest recipient of remittances, and that's a significant source of external finance for the country. Healthcare spending, 5.5% of GDP, but keep in mind, of course, if you have a low per capita income, even though your spending as a share of GDP might be relatively high, that doesn't actually translate into a high absolute level of spending in terms of dollars. A lot of inequality, of course. The richest 10% have nearly just over 40% of the income. Only 10% of females in Senegal have at least some secondary education. 1/3 of the population are in severe multidimensional poverty. The government only takes about 15% of GDP in tax. And also a very young population, less than 20 years, the median age. And these are familiar, if you like, development outcomes for lots of countries that you might have studied. Of course, they're well worth bringing into your answers. Senegal has a very mostly young population, just over 50 million, I think, in 2016, clearly rising now. But look at that. So 42% of the population in Senegal is aged less than 14 years old, and only 3% of the population is aged over 65. Now, crucially, from a Senegalese point of view, the key here is if GDP growth turns into per capita income growth. And for a large part of the sort of early part of the last decade, you can see there that there wasn't much growth of per capita incomes. But since 2014, certainly in the last 5 or 6 years, that 5, 6, 6.5, 7% growth of GDP has translated into pretty hefty growth of per capita incomes of the order of 3.5–4%. The key really is whether Senegal can continue to lift per capita incomes by that scale every year. The good news for Senegal is that last year, as of July 2019, Senegal has now been recategorised by the World Bank as a lower middle income country. Their per capita income now up to 1,410. That's in dollar terms, of course. Argentina has actually been downgraded as a share, as a country from a high income country to an upper middle income country. One of the aspects of Senegal's macroeconomy which is worth highlighting is that their growth rate of above 6% has not yet transferred into accelerating inflation. Indeed, that's one of the key features of the Senegalese economy so far. They have relative macroeconomic stability with growth of 6%, inflation less than 2%, unemployment again less than 10% of the labour force. Yes, they have a fiscal deficit. 3% of GDP is not significant really. Yes, they have quite a big external deficit of 7% of GDP. And again, as with most countries of this kind of income level, their investment spending, 31% of GDP, relatively high, is well below their national savings, 21%. Hence, there's a savings gap to overcome. It's one of the aspects of Senegal I wanted to stress with you was this aspect of macroeconomic stability. This combination of strong growth and low inflation is something that many emerging developing countries really struggle to achieve. For example, India at the moment is nowhere near getting this kind of growth and inflation balance. So it's fairly rare for fast-growing low-income countries to maintain low inflation, perhaps because Senegal has a fixed exchange rate against the euro. It does have a big external deficit in excess of 5–6% of GDP. Just dissecting that a little bit, notice at the top there that the current transfers are strongly positive, reflecting that net inflow of overseas aid and remittances. But they've got a negative service balance and they're a net importer of goods. So the key thing really there is whether they can turn that into more stronger trade performance. Negative net primary income, perhaps that's the result of a lot of foreign direct investment coming into Senegal, which then leads to repatriated profits. There's Senegal's pattern of exports. Oil is now becoming significant. Senegal is the fourth biggest economy in the West African region after Nigeria, Ghana and the Ivory Coast. Well, it's less dependent on farm exports. Clearly they do have quite a bit. The fishing industry, of course, from a West African coastal point of view is significant. But they're starting to become a kind of significant export of oil and titanium ore and also cement. Other background. The crucial thing to think about Senegal is that they have a fixed exchange rate. So Senegal is a member of the Economic Community of West African states, and the West African franc is pegged to the euro. So effectively Senegal is part of a single market of West African countries, and they have a fixed exchange rate with the euro, which of course means there's less ability for them independently to manipulate, influence, manage their exchange rate for macro purposes. Corporation tax is pretty high, although they do have special economic zones. They are relatively low on competitiveness, 114 as opposed to out of 144 countries. They're pretty good on corruption perception. They've made significant progress in improving that, but again, they're not doing particularly well on ease of doing business. But when you think about countries that are making progress on corruption, Senegal is a good example. In a continent where corruption levels are at a very high level on average, Senegal is doing pretty well on a relative basis there. What's interesting again from Senegal's perspective, it's that classic dilemma or that classic strategy, if you like, of trying to turn strong growth of GDP into better development outcomes. So one thing you might want to take away from this video is that Senegal has launched an Emerging Senegal Plan. They have an aim to become a middle income country middle-income emerging country by 2035. And here are some of their targets, some of which have been around for a few years, other which have just been introduced to lift their growth potential. They want to cut the infant mortality rate, they want to increase primary school gross enrollment, lift average schooling, which at the moment is only 3 years. They want to lift that to 3.5. They want to cut the Gini coefficient and reduce extreme poverty. And crucially, of course, they want to increase access to electricity. So at the moment, only 62% of people in Senegal have access to electricity. Crucially, they also want to lift the share of industry in GDP. So Senegal has an industrialization strategy, which of course is linked to that of trying to grow their export sectors in things like light manufacturing and tourism and textiles. Interesting aspect of Senegal, again, something to be aware of for the exam, is that it's a country on the west coast of Africa with some pretty significant oil and gas discoveries, picked up here by an article from the FT. And some estimates, the value of those oil and gas deposits could lift Senegalese GDP by perhaps 5% each year over the production horizon. So the crucial thing is whether Senegal can avoid the classic natural resource curse. They are making strides towards trying to lift renewable energy. They have over 2,000 mini grids, mini electricity and renewable energy grids, which are designed to sort of particularly to lift electricity access in urban areas. But again, Senegal is also a country at risk of the impact of climate change, and in particular the damaging effects of coastal erosion and flood risk. Tourism is another aspect you might want to link to Senegal. They have a natural comparative advantage. Nearly 700 kilometres of coastline, lots of sunshine, lots of beaches, shopping centres. So there's actually a potentially strong growth dynamic there for Senegal in tourism. But again, always be thinking, is tourism for low-income countries, is it an effective growth and development strategy? What are the arguments for? What are the potential benefits? What are the arguments, the potential risks and the drawbacks? Just very quickly, Senegal is part of a single market, the West African single market, common market, and it also shares a single currency. So the West African franc is fixed against the euro. 100,000 franc will buy you about 152 euro, and here's the chart showing the daily exchange rate between the West African franc and the euro. Not much change there. It's basically a fixed, pegged exchange rate. Now, the news is that the 8 member nations of the West African Economic Monetary Union, or WAEMU, they want to give themselves more independence from the French economy. So they want to form their own currency, which we think is going to be called the ECO, or the ECHO, which initially would remain pegged to the euro. And the French have basically agreed to this. So they're agreeing to scrap the CFA franc and create the ECO. 8 countries have it: Benin, Senegal, Togo, Mali, Niger, Ivory Coast. And they're going to try and create their own currency within their own single market, and they won't have to have half of their currency reserves in Paris under the new agreement. So definitely one worth looking at. What are the economic effects of joining a single currency in the single market in West Africa, maybe as a contrast to the European Union? Senegal growing at nearly 7% a year. However, you should be aware there were always good examples of barriers to development which you can mention. Here are 5 for you. At the moment, electricity is particularly expensive in Senegal. We talked about mini grids, but still Senegal relies on expensive oil and diesel. That puts Senegalese producers at a competitive disadvantage. There is a distinct problem with human capital. So low labour market participation, 45%, and by most criteria, a deficient education and vocational training system. I was reading that something like 2/3 of Senegalese workers are unskilled. Adult literacy is well below the sub-Saharan African average. I think it's 40% in Senegal. There's a low-income informal economy. Less than 10% of the workforce actually has formal employment. Most of the population have limited access to basic financial services, and the absence of competition in markets, the prevalence of domestic monopoly, keeps prices high, which raises the cost of living for consumers. So plenty of kind of classic barriers to growth in Senegal. Why would you apply Senegal to your A-level economics exams? Well, it's a good example of a country that's part of a single market with a single currency and fixed exchange rates. So the West African common market and single currency is a really good one to quote in contrast, for example, to the euro. Not every the single currency is not just the provenance of rich advanced countries. Earlier on in the video, we looked at how dependent Senegal was on aid, but crucially on remittances. It's nearly 10% of its GDP. Big question. Senegal has discovered oil and gas off the west coast of their country. Can Senegal avoid the natural resource curse? Can they avoid the oil curse, which has hit countries such as Angola and Nigeria? Evaluate the contribution that tourism might make to growth and development outcomes. And crucially, this situation we mentioned at the start, Senegal's HDI ranking is some distance below their GNI per capita ranking. So how can Senegal's fast growth feed through in an inclusive way and a sustainable way to really impact the lives of the bottom 40% of the population? What pro-poor policies might help to address this discrepancy? So I think lots of good reasons why the West African country of Senegal could be a good country just to be aware of as part of your preparation for development exams.